Hi everyone. In this lecture series we are going to start analyzing the statement of cash flows. Before we do an actual example and how it's done in real life, I want to start simple and show you a case and I'm going to show you the reasons why we are adding depreciation back, why we are subtracting any increases in current assets, and why we are adding any increases in current liabilities and vice versa. So I'm hoping that these simple examples will help you understand a bit better in terms of why we are doing the things we are doing in financial accounting. And the main reason is because we are starting with this notion called net income. That's our starting point. That's what we are going to start making changes, and that's the reason why we are adding depreciation back. That's why we are subtracting any increases in current assets or adding any increases in current liabilities. So our start is net income, and that's why we are doing the things we do. Now let's start simple. A company is buying $2,000 of goods in cash and selling them for $5,000 in cash, and we are going to assume no taxes and no other transactions. By just looking at this, you can say, you know what, they are getting $5,000 cash and they are paying $2,000 cash, so the cash outflow needs to be $3,000. Let's take a look at it the way it's done in accounting. We are going to calculate the revenue is $5,000, cost of goods sold is $2,000. There is no other expense and no taxes. Net income is $3,000. As a result, cash flow from operations is $3,000. So there is no question here, right? Cash flow from operations needs to be $3,000 just because we don't need to do these, but they are going to come handy as we expand the same problem. Now let's look at a case where we have exactly the same question, almost exactly, where the company is still buying $2,000 goods in cash and selling them for $5,000 cash, and the depreciation charge during this period is $300. Now if you look at this, just this, you are going to realize that the cash inflow is still $3,000, and let's calculate it in the accounting way. So what we are going to do is we are going to record $5,000, cost of goods sold is $2,000, depreciation is $300, and our net income is the difference between the revenue and the expenses. In this case we have two expense types, cost of goods sold and depreciation, so our net income is $2,700. Now for statement of cash flows, cash flow from operations, we are going to start with the net income, and we are going to add the depreciation back. Why are we adding depreciation back? Because depreciation is a non-cash charge. Remember, we are starting with net income, and net income has this non-cash charge, and if you want to calculate cash, then we need to add this non-cash charge back to the net income. Net income is our starting point. That's why we are adding depreciation back. I hope this example helps you understand why we are adding depreciation back. In the other videos, I'm going to continue with the same exercise and making it a bit more complicated.